We'll go ahead and get started. It's a little bit past 3. My name is Lisa Rodriguez. I'm the Director of Retail National Accounts here at NuView Trust Company. Today's webinar is Learn How to Invest in Turnkey Real Estate Rentals. And let's see. Okay, so just to confess, we are not attorneys, we are not CPAs, financial advisors. We're actually a non-fiduciary. So please make sure that you consult with an attorney or accountant anytime you are considering entering into an investment. And all the information and materials today are provided strictly for educational purposes. We always tell people do your own due diligence as previously discussed. NuView. Who is NuView Trust Company? So we are a full service regulated public trust company. We are a custodian. So just like the Fidelity and Schwab's of the world, we are a custodian similar to them. The difference is that they only allow you to invest in things like stocks, bonds, and mutual funds, where NuView provides you the avenue to invest in alternative investments such as real estate or private notes, private lending, private stock, cryptocurrency, and the list goes on and on. So we've been in business since 2003. We also have 2 offices. One is in South Dakota, and that is our compliance office. And then the office here in Florida is our administrative office. We currently custody $1.5 billion in client assets, and we have about 10,000 clients. What we pride ourselves on is being simple, available, and responsive. So having a simple process, being available when you call. We have a goal of 98% answering live calls, and we do look at that every single week in our staff meeting. So that is very important to us, very important that we are there to service you and also be responsive to you. So today we have Mr. Don Ganguly, and he is the founder of Home Union that was acquired by Mynd. He has many years of real estate experience, and he is a Housing Wire Vanguard Award winner. So without further ado, I have Don Ganguly.
Thanks, Lisa. Appreciate it. Hello, everyone. So what I'm going to cover today is really, some basic tenets on how to invest in single-family real estate. So when you think of single-family real estate, just some data will come about with this. There's about 18 million rental properties that are 1 to 4 units, and there's about 10 million investors. Now, the big dynamic in this market always has been that people invest locally, and one of the reasons they invest locally is that they don't have a good way to invest remotely, and that's kind of what we're going to talk about today: is how do you invest in real estate regardless of location. So. About Mynd Management, which is our 2-second plug of what we are and who we, and what we do. So we're a one-stop shop all the way from researching the property, acquiring the property, getting renovated to get it rent ready, to managing the property, and finally, when you go to sell it, it goes to sell the property. And why is this important? A lot of time people buy, single-family real estate, and then they go and find a third-party property manager to manage that property. Now think of stocks and bonds, and I'll use that comparison quite a bit as we move through this presentation. So if you went to any wealth advisor and say, I've got this pot of money, this nest egg, and I'd like to invest this, and the advisor may come back and say, okay, based on your risk profile, this is where you should put it: stocks, bonds, and however whether you're in the middle and the high end, international stocks. After you're done with that, you have a portfolio. And then if that wealth manager then says, I'm not going to manage your portfolio, it's going to be managed by Joe's portfolio management shop across the street, I think you'll be very perturbed, because you just went with this person to select your assets, and then you've got someone else that's managing your assets. So in real estate, people don't think twice doing that. I mean, they buy what is a pretty large investment, and then they go find a local small property manager to manage it, and they somehow trust that it's going to be okay. So this is where I think Mynd Management is more of an institutional management company that's bringing that to retail investors like all of you on the call today. And our co-founders are fairly illustrious. They were one of the first ones to build a public REIT that was investing in single-family rentals, which then merged with Colony, which then merged with Investment in Invitation Homes, and became a fairly large public company, one of the largest ones out there. So there was a lot of experience in dealing with this asset class at scale. And there was also a lot of, let's say, appreciation of the pains that an investor might feel when their property is being managed. So that whole experience is what we brought into the retail investor realm. And so we manage about 7,000 units in 22 markets. And so that's a strong piece of security for folks that invest through us, knowing that we are the same entity that is going to manage what we helped you buy. So that's quite a big. And Mynd Investor Services is on the acquisition, sales, and lending. We do offer. We have Mynd Mortgage that offers lending for investment properties and others. If you want to take a loan, and most people do. We have an umbrella insurance policy that actually gets you better coverage with a more competitive price, because it covers all. It gets a scale of all the units that we manage, and a retail investor won't be able to get those rates. So things like that. We also have a listing service, so we can sell your property to another investor or homeowner when you get ready. So it's a full service platform. So here are the issues. When an investor, a lot of folks end up investing in their own backyard. And the reason they do is because they can't answer these questions. They know their own backyard. They already own a home there, so they're not really diversifying when they go into their own backyard, because you already own a home, you're part of that economy. If something happens, both those properties are going to take a dive, right? So the reason people do this is they don't know where the best properties are located. So one of the theses we have is, I don't need to live in Atlanta to buy Coke stock. So why do I need to live in Atlanta to buy rental properties in Atlanta? And that's really the problem that we're solving, which is give you enough data so you can find the best properties regardless of location. This is something you want. And then, once you get that, how do you know what the best price is, right? I mean, the realtor, or if you just rely on a real estate agent, they're going to come back and say, hey, we think this is what, this is a fair price, this is what we should go for. And you don't know what that market is doing. You don't know the dynamics. So there's data, again, that can give you that. That's the beauty of data to these days. Once you get that, then you, of course, want to get the property financed. You want insurance. Now you're dealing with multiple vendors. And the complexity of this gets you. And finally, you're like, I'm here, the property's in Atlanta. What if something doesn't work right? What if the management falls apart? I can't, fly into Atlanta and try and do this, and all my profits will be gone. So that's the other problem you're trying to solve. And finally, you may decide that your property is appreciated quite a bit, and now it's time to sell, and you're back asking the same questions, right? What should I sell it at? Who will sell it for me, and so on and so forth. So these are kind of the main core questions that real estate investors ask, and if they don't get the right answers, there's a certain affinity to real estate, and so they end up saying, okay, I might as well buy something in that other neighborhood close to me, and at least I can eyeball it and manage it, and that just doesn't reduce the risk anymore. The other point here, it's important to note now with COVID, which is our new normal, is commercial real estate has really taken a little bit of a beating, right? Because people are working out of their houses, retail stores are, a lot of them are closed or unfortunately gone out of business. And this co-working and having an office where everybody needs to go to is not as big. So what are people doing? There's a flight to suburbia. They're going to single-family homes. They're trying to get homes where both partners, can get an office of their own, and if they have kids, and they have space for the kids. So if they need to work out of their house, which a lot of us are doing, then the house at least has the amenities to support, the work lifestyle structure. And that's another thing that's adding more demand into the single-family asset class. We're seeing a real high demand as a result of this. Prices are going up quite a bit. So it's a good time to buy. And a lot of time people buy for cash flow, but right now you get cash flow, but you can also get pretty good growth. So this is how people invest today, right? So there's a large number of investors. There's about, close to 1 million transactions. It's 800 to 1,000 to 1 million a year of investors buying. And what do? They go to a listing site like a Zillow or a Realtor.com, and they go find something they like. Then they call a local realtor or a realtor they know and say, hey, that price looks good. I want to buy in that neighborhood. The neighborhood looks good. I've done a back of the envelope calculation. And they're now working with this realtor to go do that deal. And the realtor's got local tribal knowledge and some of the other things. So what we are trying to do here is really put all of this into a simple data-driven platform that I'll show you a little bit of. And there are a few others like us that do this, which offer investors the same way to invest as they would in the stock market. And we'll talk about that a little bit of how we do that. So really, if you look at the investment process, when you look at stocks and bonds, you're more tuned to talking about your financial goals. How do what sort of return do you want? Do you need some dividend stocks? Do you need some bonds that are going to give you some money, or can you hold for the long haul? Is there a retirement horizon? Is there a kid that's going to go to college? So there's all these different iterations that you can use to actually figure out what kind of funds and what kind of investment thesis you should have. But very few people approach real estate the same way, and the value is just as much, if not more, from a return perspective. And the beauty of real estate, residential real estate especially, it's non-correlated to the stock market. So what that means is that if the stock market goes up and down, it doesn't go in the same direction. So it's a real good hedge, against having money in stocks and then diversifying to real estate. Now, so you start with a buy box, and then you sort of search based on that buy box, right? And so the buy box is where the starting point is. This is how much I have to invest. This is what I'm looking for from the investment. Here's my risk profile, so on and so forth. And then there are the execution steps of analyzing that, then putting out an offer, closing that property, renovating it, doing due diligence on it prior to close, and then having somebody manage it for you, right? So that we can provide some data on just not, oh, you're getting a rent or you're not getting a rent, but some performance data saying you put in this much money, here are the type of returns you're getting, and then some advice saying, hey, you've got a property maybe in Northern California in the Bay Area or some other high rent district, and it's appreciated quite a lot. Should you take some money off the table and sell that and maybe buy 2 homes in Atlanta or Tampa or Charlotte or Raleigh, where the economies are just as robust, and sometimes more. But you don't have to pay the same kind of dollar for the same kind of home that you did in New York or California and in some of the more rich city or the near suburban areas. So you have an ability to play in a much bigger sandbox and decide how you want to play there. So that's the advantage of this. So if you look at what we do here is really provide you a risk reward profile, which sort of says, if I invest here, that's a higher return, but what sort of risk is it? So bonds tell you this is a AAA bond, this is a double B or a C. So you know that higher return you're getting with that particular C bond is associated with more volatility and a high risk, right? So in real estate, there's nothing like that. So we've got something we call neighborhood investment rating that we'll talk about that gives you something like that in terms of neighborhoods that are more stable or less stable, high returns or low returns. And how do we do this? We have the entire housing stock, 110 million properties. We've got about 9 million rental listings. We've got close to 20 years of history. So we take all this data and then we build our models based on transactions and trends and histories. And we'll show you, we even have geocodes that shows us, power lines and railways and cemeteries, because sometimes having a rental home close to one of these locations may actually make it tougher to rent or even tougher to sell. So there are things like that we've incorporated distance vectors that we try and de-risk it. For example, if you're going to buy a rental property, one thing we exclude when we bring in listings is our properties with pools. It's much tougher to maintain, and you don't want to rent over the pool. There's liability, other issues. So the way we do this is in any market, we actually access all the available inventory. So whatever is listed on the MLS, we have a real-time connection, and we apply a bunch of filters, what we call investment grade filters, so that we're not ingesting the entire MLS. We're ingesting what we think are properties that are in the neighborhoods that we think are good investment grade, that have a good return, good growth, or good yield, school districts, what have you, and are falling within a certain boundary that we feel are sort of within a tolerance of risk. And as these properties come in every 30 minutes or so, we're able to refresh and get them in the door. So the other is off-market properties, properties from builders, new constructions, which are require less due diligence. You have builder warranties. All of that comes into a platform that somebody can actually work with. So here's some of the things that we provide. Neighborhood investment rating. We rate neighborhoods from A through C, and think of a C neighborhood as a C bond, higher returns, lower quantum of investment, but more volatile. An A neighborhood is a higher quantum of investment, more expensive houses, lower return, lower yield, cash flow, but higher growth. These may appreciate more. So it's a matter of where you want to play. We obviously we predict the rent, we predict the price. We do a thing called right bid, which is very interesting because you want to know, what should I bid for a particular property? I don't want to put too much money. At the same time, I don't want to leave money on the table. At the same time, I don't want to be at a price where I'm actually not getting deals. So the right bid looks at the velocity of a neighborhood and then says, okay, your best bet for getting the best returns are between this price and this price. And so every property we have in every neighborhood has a right bid algorithm that we put out there so investors have an idea. Some of the other things here, like investment property tax, sounds trivial, but it isn't. In a lot of jurisdiction, the taxes you pay when a property is non-owner occupied is actually quite a bit more than taxes you pay if it's owner occupied. And if you don't factor that into your calculations, you're very likely to actually have data that's inaccurate and projections that are inaccurate. And we obviously model crime and things like that. So there's a bunch of things that we model that I'll show you very quickly on the site when we get to it. So here is some examples of sort of things. We have school districts, we have Starbucks, we look at Walmart, we look at a lot of associated things when we actually rate these neighborhoods. We look at income, we look at diversity of income, how many employers are there, what sort of crime is out there. So lots of things that go into us saying this is an A, B, or C neighborhood. Just like when a bond is rated A, B, or C, there's a ton of investment and analytics that go behind it. So we're pretty much doing the same thing here for our investors. So if you look at the portal, which I'll get into in a second here, so what we have is really an intelligent search and match engine. So a potential investor can come in here and say, here's what I want to invest, here's my risk orientation, here's the type of location I'm looking for, and we give you a simple map-based way to actually evaluate properties. And the platform is designed to sort of peel like an onion. You can go deeper and deeper. If you're more sophisticated, you can get more and more data. If that much data isn't your gig, then you can look at it at a higher level, and we have support folks that help you. But in general, more than pitching our platform, these are the sort of things you want to look at when you're looking at buying a rental property. So we've got the whole 110 million properties, 200,000 neighborhoods that feed into it. We're active in 22 markets right now because that's where we manage. So our thesis is that we do not just put the platform out there for you to invest if we can't put our stamp of, or if we can't support the management of it, because the management goes a long way for you to really hit your returns. So with that, I will get into a little demo that will show you exactly how this works. So here's a map of the United States, right? So if I go here, I can say this is Atlanta. Now this is a quick overview of Atlanta, right? It shows this is Tampa. Let me just go back here. So it shows there's about 566 properties in the portal. The average price is 125 to 256K, and then if I want to click into it, I can actually start looking at properties within Atlanta. So it's a simple map-based way, and it shows you where the properties are clustered. So if you want to know the neighborhoods, you can, just like you do in Zillow, you can look here and say, what property is it? It's in a property. This is in a C neighborhood. It's got a list price of 233,000. So it's a very easy way for you to quickly arrive at, if you want to be at a certain price range or a certain property from a visual standpoint. So you can start with the United States and then go down to a particular city, and then from a city, you can drill down into neighborhoods, right? So over here, we've got the same kind of thing that a Zillow would have. So we would have all the locations that we're in, are shown here. So you can look at, Georgia, you can look at California, you can look at, on and on. So wherever you want to be. And then we've got price. So you can look at something for what the price is going to be or what your investment amount is going to be. You can pick either one of them. If you say, I'm going to take a loan, I only want to invest $50,000, $25,000, you can put in that $25,000 and see what kind of property you can get for that budget, right? So it's an investment filter. We have the standard property filters, which are, exclusive deals, which only we have, nobody else has, stuff that's recently added, what we call hot investments, stuff that's moving quickly. And then you can put the bed, bath, and all these other things in here, which are all, the standard house-related features, which you know when you buy a house. The other thing we have, which is unique to us, are the investment filters. So are you going to buy financed? Are you going to buy all cash? And then you can actually say, hey, I'm looking for a monthly cash flow. I really want $100, $200 a month. What kind of properties will give me that? And will give you properties that way. Or you might say, I don't really need cash flow. I need a certain growth. So, it's like a stock that's growing. I want it to be growing at a certain rate. What properties are growing at a certain rate? Because we are forecasting growth. Then you can even, even define your school rating. So, there's a bigger school, greater schools rating. So we can go all the way up here and say, I want a 10 or I want a 1, depending on what your school rating should be. And again, you can also define your neighborhood risk rating. So you can say, I want an A or B or C neighborhood, depending on what your risk appetite is. So as I said earlier, this is kind of a risk reward scenario with which you can define your search parameters as the amount you want to invest, the location where you want to invest, or you can go multiple locations and see what's available in a bunch of different places. If you really bought into the South, you can say, I want to look at Atlanta, Tampa, Dallas. A lot of people in the Bay Area are saying, hey, I think Austin's the next Bay Area, and they're just focused on Austin, so you can do that. So it's very flexible, location-based, parameter-based, budget-based, property type-based, neighborhood-based, so you can do all of these things. So then let's say you want to come in and say, I want to look at a particular property. You can actually then go in and do a deep dive on any of these properties, right? So for example, if you want to come to one of these here, so let's say this one is 30 days on Home Union. So I come in here and now, so as I said, I am coming down one by one, right? So I saw a note here, somebody saying, is this a Zillow platform? It's not the Zillow platform. It is sort of the Zillow platform for investing. So what Zillow does for buying homes, we do for investing in homes, right? So I'm just going to sign in here very quickly. And you do need to register after a couple of free searches so that you use the platform. It's free, but we ask you to register and tell us who you are so we can be a little more focused. So here, you can look at a bunch of different things, right? Here's some highlights of the property. This is a listing price. Here's the estimated rent. Here's what we think it's going to take if you're going to finance for the total investment. So the investment properties typically are 25%, will give you a better rate with your loan. And then there's some closing costs that we estimate. So this is sort of the cap rate. If you're familiar with that, the yield on the property, this is the yearly cash flow. This is what we think is a first year value expansion. This is the cash on cash return, and this is a 15-year total return. So we're trying to give you an overall picture. You have some listing details like you would in any site, but there are a few things we do differently. We actually show you some price and rent trends, in that neighborhood, and then in that market, and similar neighborhood in the city. So one thing I want to say here, the city or the metro means very little to us. Real estate is hyper local. Everything we do is neighborhood based, because within a city, everything changes from neighborhood to neighborhood, and within a neighborhood as well. Houses may look different based on the amount of work that's been done to it or what have you. But by and large, a neighborhood is a more homogeneous unit than a city. So what you're looking at is price, and then you can do the same thing with rent and say, hey, what's the rent look like in this neighborhood? And you can see we're actually modeling it from 2001, 2000, and all the way, and you can see what the general trends have been in rent and price. And as you can see, this is why I say real estate's not correlated with the stock market. I mean, it had a little dive here if you look, but over time, the trend is always fairly positive. So that gives you kind of a quick idea. And then if you really want to get into more details, you can actually start looking at the financial details here, right? So you can say, okay, this is my rent, this is my price, this is my down payment, and each of these things you can change. So if you want to change it and see what the data does, have at it. This is like a little calculator that you can use. And then you get a quick financial that says, hey, here's your rent, here's your price, here's your property taxes, here's your insurance, this is your cash flow on this property, right? And here are your assumptions. And then if you come down and you say, yeah, that's cool, and you look at it over, and we have a graph that kind of shows this over 30 years. So you're looking at your total, projected wealth, you're looking at how much your equity is, and how much your cash flow is. So each of these things are right here. Cash flow appreciation and your principal, your loan pay down, so your principal keeps increasing. Now, you might be someone that says, that's not good enough for me. I need a full pro forma. So this is what I meant by peeling the onion. So if you're a real sophisticated investor, you can come in and look at all the assumptions, all the operating expenses, and see what this might look like for you in terms of how we arrived at the cash flow. Now, you might look at this here and say, hey, this is interesting, but let me just look at your assumptions. I don't like your assumptions. And we show you what our base assumptions are. So what our appreciation rates are, what the vacancy rates are, what our rental growth is, and what our rehab costs are on this property. And you can come in here and change these, and the calculation changes. And so you can kind of use this as a sophisticated spreadsheet to do your own thing. These are all sort of tools to allow you to simply look at, what a property does. Now, the other thing we have is this rich neighborhood information. So we show you, how many homeowners are there in this neighborhood, what percentage of renters, where's the median rent in this neighborhood, so you can see whether your rent is too high or too low. If it's a really high rent, you know that you may get this one renter, but you may have a problem later on. So what percentage of people are paying that rent? What's the rent affordability in that neighborhood? That kind of tells you, if you say 50 above 556, above 742. So if you're above 1,500, only 7.1% of the people in that neighborhood can afford that rent. So if you're buying a property in this neighborhood with that rent, I would, you should sort of think and say, hey, when that renter leaves, I may have a tough time replicating that rent. So then we provide things like, what's a commute time? What's the income range in that neighborhood? What are the demographics by industry? What's the age distribution? So there's a lot of stuff that even when you're sort of surfing your own backyard, you don't have, which we give you, which kind of, if you look at the cash flow of your rental property, it is the renter. So this is where we're giving you information about the renter, about the neighborhood, and some financial data. Now, the other thing you might say, okay, so you give me that rent, you give me that price. How do I know those are right? Right. So this is where we show you rent comps and price comps on properties that have recently sold or have been listed close by, and the rent per square feet. So you can actually do the full due diligence and say, hey, where did they come up with that number? And are similar homes renting for similar amounts or not? And what we do in this analysis is we have a valuation model. Then we actually go out and look at comps and say, hey, within a close distance, are there properties that sold that are close to this price? And if you don't find something in close distance, then we go a little further. And then if you don't find anything, then we go back in time a little bit. So we're trying to figure out very quickly, if the rents that we are saying for this house is actually a valid rent. Because if that rent you don't come through with that rent, then obviously everything changes in your thesis. So there's a lot of things here that we provide you as a user to come in and do a deep dive and do your due diligence and all of these things around the property. So, and then you can do things like, put it on your watch list. If you want a loan, we have Mynd Mortgage, where you can come in and actually apply for a loan, and it's an investment loan. All our loan officers are really focused on investment loans, so we can get you a loan based on the property. If you don't qualify for a Fannie Freddie loan, we'll look at a non-qualified mortgage depending on what you do. Fannie Freddie, you get loans up to 10 properties, including your own home, which are obviously at better rates, and a lot of our investors take advantage of that. So things like that. If you want to sell your property, you can do that as well. We have a whole sort of a property sales platform where you can sell locally to a homeowner. We have 100,000 subscribers. You can sell to an investor network. So it's a full cycle from doing the analysis, doing the research, and then we have boots on the ground in all these markets. So when you come in and one of our advisors is working with you, we will then work with our boots on the ground to actually make an offer on the property, do due diligence on it, make sure that it's got everything on the inside that we thought it would, and if it doesn't, we back out of it. And when you close on it, we've got a construction team that goes in, does a renovation, and then hands it over to our property management team that takes it from there and manages the property for you. So it's that full cycle, but it all starts with this data up front and an ability for you to analyze properties in any location based on your risk, based on your budget, based on your preferences, age, stage, goal in life, and all of those things. So with that, let me stop and hand it back, and let's continue with the other part of this presentation. So this is the rental property piece. I already talked about this, so we can move on. Finally, this is sort of, if you want to go find out more, you can go to homeunion.com and sign up. This gives you the homepage, investor.homeunion.com, takes you straight to the portal that I showed you. And at the end of the presentation, I'll give you my email ID. So if you want to ping me directly on any questions that didn't get answered, I'm happy to respond to you as well.
All right. Well, thank you so much, Don. We are going to go through a small presentation here on self-directed IRAs, but Don is going to be available at the end of the presentation for those of you that have questions specific to him. But my name again is Lisa Rodriguez, and I'm with NuView, and I'm going to talk a little bit about self-directed IRAs and how they would fit in something like this. First of all, just wanted to point out that the IRA market is a very large market. So many people don't know that they can use their IRAs to invest in things like real estate or private lending or private stock and crypto, precious metals. So I like to make sure I bring that to people's attention, because if you are a real estate investor, for example, think of all the other people's money you can also be using that are in IRAs, or your own IRA money that you could be using to make real estate investments. So this next slide, for those of you that already are investing in real estate, for example, what I wanted to point out in this slide is to show if you have any investment, let's just say you have $1 and you have an investment that's going to double every year for 20 years. So first year it goes from $1 to $2, $2 to $4. Oh, but wait, we have that yucky thing called taxes, right? So the dollar doesn't turn into $2, it actually turns into $1.75. And then when it doubles, it doesn't go to 4, it goes to 306, and on and on and on. But after 20 years, it's still a good investment. You started with $1, it doubled over 20 years, and it ended up being $72,570. If I had the same scenario, same dollar to start out with, same doubling of the dollar every year for 20 years, but I did it in a Roth IRA, what do you think is going to be the difference? Instead of $72,570, how much do you think it's going to be at the end of 20 years without having to worry about paying taxes? And in the Roth, you would pay them in advance, right? So for those of you that want to know, sorry, I'm getting to it. It would actually turn into over $1 million, right? So same dollar, same doubling, same investment, same time frame, except without having to pay taxes year after year after year, you end up with $1,048,000. So I don't know about you, but I want to be telling the second story, right? And if you did that in a traditional IRA where you don't pay any taxes up front and it builds to $1,048,000, and let's just say you took all of that at one time at a high tax bracket of, let's say, 40%, you're still going to walk away with over 600,000. 600,000 sounds a lot better than 72,000. So just want to point out the power of the self-directed IRA, and the fact that, you don't have to pay capital gains tax, right? So that's a big thing when you're buying rental properties. Just a couple of things, I want to mention about what you can't do in your IRA. So one of the things you can't do is you can't buy life insurance. And the other thing that you can't do is you can't buy collectibles. So I like to think of the IRS as an example that I would use is, I have two small children, two boys, and I'm always like, don't do that, don't touch that, don't jump on that, don't jump off of that, and that's what the IRS does. They don't tell us what we can do, they just tell us what we can't do, right? So you can't purchase the life insurance and you can't purchase collectibles. And there's a small amount of people that you can't do business with, and those people are yourself, your kids, grandkids, parents, grandparents, spouses of any of those individuals, and businesses that are owned by those individuals. Other than that, you have a whole array, millions of people that you can do business with. So, the IRS just does not want us to be too close to the deal. They want to make sure there's no personal gain there. It's all about increasing your retirement. So whether it's raw land or rentals or rehabbing, you can do all of those things inside of your IRA. And I liked what Don went over when he was talking about the rental properties. And my example is going to be a lot less information than what Dot shared, but it's just to give you an overall perspective. So let's say, for example, you're buying a house at $150,000 and you had that much money in your IRA. Let's say you're renting the house out for $1,500 a month, and there's 12 months in a year. So that's $18,000 a year. Obviously, you have to pay your property taxes and insurance. So let's just take out $3,000 a year for that. But again, the reminder is capital gains, zero, right? So let's say you keep the house for 5 years, you're making $15,000 a year. That's $75,000 that you have going back into your IRA. Again, no capital gains. So you decide that, you want to move on. Maybe you want to get a bigger house or something like that for your investment property. You decide to sell the house. Well, after the 5th year, let's say with appreciation, the $150,000 house is now worth $200,000. So $200,000, and you bought it for $150,000. So you're going to make $50,000 on that. So if you kind of, look at the deal over the last 5 years, total profits would have been $125,000 in 5 years. And that goes right back into your IRA. So that is how you can build your IRA outside of stocks, bonds, mutual funds. And again, not pay any capital gains tax. So another way you can do deals is through multi-party real estate. So let's say that you buy a property at $135,000, you rehab it for $50,000, your after repair value is between $210,000 and $220,000. You can get about $2,000 of rent for it. These are the ways that some of our clients structure their deals, right? So one, they have a mixture of SDIRAs and a mixture of cash, right? They split all expenses the same percentage of ownership and all income the same percentage of ownership. Or they can set it up via an LLC and divide that on the title. The other option is doing a joint venture. So party A buys the house, party B rehabs the house, and they split the profits at a predetermined amount. And that allows all parties to have, their own specialty. And then the third, the IRA can take a non-recourse loan. So, you can take a loan with the IRA. It just has to be non-recourse. It can't have a personal guarantee. And when you do that, sometimes it will subject you to the UDFI taxes. So you'll want to be familiar with that and talk to your CPA about that ahead of time. I won't get into any more details other than, for being a part of the webinar today and trying to take participation in learning, we are going to waive your application fee. If you're interested in learning more, we're happy to speak to you about that. What it costs to wait is basically opportunity, right? You probably have your money in the stock market, and yeah, it looks good a lot of times, but sometimes it doesn't. And so you're subject to that volatility, and you're still paying commissions to your advisors. And where here, you know, it's self-directed. So you're doing that for yourself. And we have a very competitive fee structure. So we encourage you to give us a call and talk about that. If you want to learn more about the SDIRA side, so self-directed IRAs, you can text SDIRA and your first and last name to 484848. My contact information is there specifically, but we're all here happy to help you. And then what I'm going to do now is get back to the Q&A. So I do see that there's some information in here. So bear with me just a moment, and we're going to bring Dawn back on. So let's see here. It looks like Dawn answered in the chat about how fees are. Okay, so let's go back here. We can find the property in an area you manage
Yeah,
in, and you will.
Can you hear me? I can see those. I can actually respond.
Oh, you can see them? Okay, great, wonderful.
Yeah. So I think Ed's asking the question, so the answer to that question is depends, unfortunately. If you find a property in a neighborhood that we don't think we can support, or you buy a property where you know, the condition is in a certain situation and you do not want to rehab it to the level it needs to be for us to, you know, get a proper renter in there, we may not be able to do it. So that's, but you know, on the other hand, if you find a property and likelihood you buy it in a decent neighborhood and you've got a decent condition, we'll absolutely manage it. No issues there.
Don, can you read the question just so everybody knows, because they cannot see it?
Yeah,
only
I
we
will.
can see it.
Yeah.
Thank you.
Yeah, Stephen's question is, are all these properties either rented or in rental condition needing no repairs? Answer to that question is no. There are rented properties on the platform, but many of them that you might buy are properties that are on the market, so they'd be vacant. So you would have to, you know, put in a little bit of money to make that in sort of a rent-ready condition. We also work with some builders where we get new construction, sort of a build-to-rent type of a neighborhood, and in those instances, obviously there are no repairs, there are builder warranties, but if they're still vacant, then you would have to find a tenant, so which we would do for you, obviously. Stephen's got a question that says, are you also property managers locating renters if the property is vacant? The answer is obviously yes. That's a key piece of what Mynd does as a property management company. Jess's question is, do you project maintenance and repair expenses? We do project it, but I want to caveat it by saying that this is probably one of the more uncertain pieces. In real estate, you don't have something like Carfax, which tells you all the work that was done to a house, unless somebody registered that with the county or the city. So we're really taking you know, making an estimate looking at the outside, because we can't go in and look at the inside on all these properties. Now, one of the things we do is when we get into contract is we have an option period when we actually go in with an inspector and look at that property and see if those repairs are too high. If they're too high, we back out of that property. Now, since we manage 7,000 properties, our goal over time is to feed that data back into our maintenance and repair forecasts. So at least at a neighborhood level, we can say, hey, you know, this neighborhood, this vintage of house, we're typically seeing these kinds of maintenance and repair expenses. So we have that advantage of someone that's an operator that can feed that data back versus just being a platform. But this is the toughest one to actually nail down, because you know, every house is so unique in certain ways based on how it was treated, right? The next one, the next two are asking for videos of this presentation.
Yes, I'll address that.
Okay.
So this presentation will be housed in our blog section at the NuViewTrust.com website under blog, and it'll be there by Monday the latest, probably by tomorrow afternoon, but just in case, by Monday. So it's just NuViewTrust.com/blog, and it'll be the first video that you see there.
Okay.
Let's see. There's
Debbie's
some more
asking a question. Yeah, if we own several properties, how does the umbrella? So the umbrella works if we are managing your property. So the insurance company underwrites a risk if Mynd is managing the property, and so if your properties, and it doesn't have to be, if you've got some properties that are outside our area, then, you know, I think you'd have a retail insurance there. But if there are properties within our area that we would take on, then you would qualify for that umbrella policy. And a lot of people are doing that with us. Stephanie's asking the question, what do I need to do to find lending funds for real estate investing? There's no magic bullet. I mean, we're not big subscribers to this get real estate done with no money. You really can't, just like you can't buy a home with no money. You need a certain amount of funds. I would say in the neighborhoods that we operate and in the cities where we're in, you're looking at a $25,000 to $50,000 investment by the time you've bought the house and you've paid the closing costs and you've paid for some amount of renovation. You're looking for that to get in. I would not advise you to get in if you have less than that. One of the things is there are parts of the country where homes are $60,000, $70,000, and we just don't work in those areas because we find the volatility to be very, very high. So you can get a good rent to price ratio, but tenants are changing and the condition of the house is not really great at times, and it's very difficult to manage. So we're sort of, if you look at most of the public REITs and us, we're in that we're sort of managing homes that are in the 100, 120,000 up to, I would say, 250, 300,000. That's kind of the sweet spot of rental properties that we see.
And then
so that's,
Mike,
I think, the last question. Oh, yes. Mike's got a question for Lisa.
So how does investing work with a real estate syndication at NuView? There's a couple of different platforms that we have here at NuView. We do have an institutional division and we have the retail division. So it depends on the syndication, how large it is, how many investors are involved, but I'd love to chat with you, specifically about your scenario offline. So I will reach out to you. Any other questions? And the chat was answered. Well, thank you so much, Don. We appreciate your time. We have one last thing that came in. Do you have a SW program like Home Union for apartment investing?
No, we don't. The apartment market does not have a great listing. I mean, you can go to LoopNet, and LoopNet it's really tightly controlled by some brokers like Marcus Millichap and a few others, and they trade within that environment. They don't really take it out of that environment. So that's why there's not a public trading place to find these. If you go to LoopNet is a place where a lot of these apartments show up when the brokers haven't been able to sell it in a reasonable period of time. So you're kind of getting the leftovers a little bit, but it's still a place to go find apartments.
Well, wonderful. Thanks again, Don. We appreciate your time. If anybody would like to speak with Don further, you have his email address right there on the slide. If you'd like to talk with us at NuView, you also can contact us here, again, at NuViewTrust.com or directly to me, L. Rodriguez at NuViewIRA.com. Have a wonderful day, and thank you so much for your time, everyone.